Good morning and welcome to Chris & Co, the show looking at what affects business in Kent with me, Chris Price. Joining me this week are Mark Quinn, Managing Director of housebuilder Quinn Estates, and Shahan Lall of property developer Lall Group. We'll be discussing the troubles some small businesses have accessing finance. First, we're looking at the direction of house prices across Kent. In November, house price growth jumped to its highest level since March, according to data from the Halifax. However, many analysts expect house prices to slow this year. Louisa Britton looks at the market in Kent.
Over the last year, house prices have gone up in the UK, and the situation is no different in Kent. Across the county, the cost of an average property has risen as demand for houses stays higher than the supply available. This house you see behind me here in Rochester has recently been sold, and since last year its price will have gone up quite significantly. That's because across Kent the average house price has gone up by 14%. In 2015 the average house cost a little more than £285,000. By the end of 2016 this number had risen above the £300,000 mark. But if you look at the figures more closely, this rise hasn't been continuous. House prices have actually seen a fall in the last 2 quarters of 2016. So what can we expect for the new year?
We're still pretty confident that house prices will increase in 2017. Post-Brexit there was certainly a slowdown, but it's all about supply and demand. So at the moment there is still a massive demand to buy property. Let's face it, we don't really know where we are in terms of how we're going to negotiate our exit from the EU. So I think that uncertainty just makes people feel a little bit nervous. And if you're investing money, people want to be confident, and therefore, that will have an impact, but I don't think to a material degree. I think house prices will still rise, although not at the rate that we've seen maybe in 2016.
Louisa Britton, KMTV.
So, Mark, according to the Halifax there, house prices in Kent have actually fallen over the last 2 quarters. Is that a trend that you think will continue this year?
Well, it's something we spoke about recently. We as a company think that there are a number of risk factors coming forwards with Article 50s being evoked, and that will be basically inflation, what happens due to the pound's fall in terms of inflation, and whether the government uses interest rates to control that inflation risk. So our feeling is that it probably won't be as bad as we thought it might be. We think that the economy is trading pretty well at the moment. That's the feeling that we're getting from people. So I actually think that in terms of house prices, it will probably have a small increase rather than a dip. I do think there are places in the southeast where you're going to see it dip, and they're basically non-prime, and also we think London. We think London at the moment, companies like Barratt's are struggling to sell luxury flats, and so you're seeing bulk deals going to PRS companies, private rented sector companies, and you're also seeing discounting take place because you've got 50,000 flats being built at the moment in London, and you probably haven't got 50,000 foreign people who want to buy those flats to hold them. So that's essentially what we think will happen.
Shahan, what do you think are the biggest factors determining house prices at the moment, and will they carry on going up?
I mean, I tend to agree with Mark, Chris, on the nuances, particularly within the southeast. I mean, ultimately it comes down to supply and demand. Reaching the demand for the supply just isn't going to happen. The migration from London is a big factor. There's a huge population coming out to the southeast, in particularly Kent, due to the high-speed links, and that ultimately will also help to raise the house prices. There are other factors coming into play. A mortgage market review, the MMR, which came into 2014, is having a huge impact on people being able to actually afford to get onto the property ladder. That again will boost the supply-demand differential, again adding to the case that prices can then rise again in the southeast.
The biggest group that is losing out from rising prices in Kent particularly are first-time buyers. I mean, what advice would you give to people looking to get onto the ladder for the first time?
I think that one, they need to make sure that their cards are lined up in terms of they need to make sure that they're saving for a deposit. They need to make sure they've sorted out their credit score, and they basically also probably need to go and speak to their mum and dad. because essentially what's happened is you've had a generation that have become extremely rich from too few houses being developed. You've had significant undersupply, basically, housing for probably 2 decades now. And what that's basically caused is a disconnect. So you've got young people who can't get on the housing ladder, and you've got older people who are complaining about development taking place in their neighbourhood because they don't want any houses built. But unfortunately, people are going to have to realise that you can't take the head in the sand approach and say, well, I'm all right, unlucky. That isn't going to work. I think this government has a moral obligation to ensure that more houses are being built. It's very simple. If you've got 20 different companies selling houses, the price goes down because they're all competing against each other. And in Canterbury district at the moment, we are the only people who have got any major site building houses. Now, to me, that's terrible. And you know, it's a real. I think it's a real shame for young people, because when you own your own house, it gives you a sense of value in your community. It gives you a sense of pride because you feel you own part of where you live. And I think that, you know, that's a real kind of pillar of society, home ownership. And I think it's one that we need to try and encourage more, not just to make us richer, I think, so that you get less discord and less disconnect between generations.
But one of the other things that's keeping house prices high has been the growth of buy-to-let. It's a sector that you're in, Shahan.
Yeah.
And how do you think that that the government has done quite a lot to try and make it more difficult for buy-to-let investors, rising stamp duty or whatever? I mean, is that fair? Also, are first-time buyers, for example, really facing a real uphill battle with the rise of this kind of property development?
Chris, I think that's key. Again, I'll go back to just briefly what Mark said, that there's not enough incentive for smaller to mid-sized developers to actually be able to get planning consent and build out these homes, which is always going to affect the supply differential again. But in terms of the buy-to-let market, you know, traditionally it was lots of people could come into as an individual buy-to-let market. The Prudential Regulation Authority, which came into 2012, is adopting some very harsh steps in April. Well, what that will do is essentially take out the small portfolio to individual buy-to-let market. It will then focus then on the professional landlord market, such as ourselves, and that will ultimately boost private rented schemes. Ultimately, private rented schemes have come about because first-time buyers can't get onto the market, and essentially they're looking to get their independence away from mum and dad. They're coming out of university or early in the working world. They can't find that space for themselves. So the private rented scheme is a model that is going to continue. Unfortunately, with the supply differential, it's just going to lead to increased house prices unless developers can get on site and build more homes.
Okay, Mark. One of the things that some people say is it's in the interests for developers to slowly release houses to keep prices high, because otherwise you're impacting on a developer's profits. If they build too many houses too quickly, then all of a sudden the amount that they're going to be able to return is going to be lower. I mean, is that a factor in house prices staying high at the moment?
No, I don't think it is. The reason why is because most house builders got rid of their land teams in the last recession and they haven't got them back. So what you'll find is a number of people like us take risk on planning, we take risk on putting infrastructure in, and there's no real issue in terms of people paying for it. When a house builder buys a site, he needs to get a return on capital employed, ROCE they call it. So that managing director will be under huge pressure to build those houses as quickly as possible. This is shown by what happened at Bovis. They're actually paying people to take a house early. So that is, to me, just complete fallacy. That developers are sitting on land. They need to make them. When you've spent that much money on a planning application, you've got to get that site delivering money back into your coffers as quickly as possible. And you know, we find that people are in a rush to get building. At the moment, you have got such a huge disconnect between how many houses councils are granting planning, because they didn't grant very many houses planning for the last probably more than a decade, I would say. And then there's got to be a kind of will from people in general to try and help younger people get on the ladder.
Sure, Mark. Thanks very much. We're going to have to leave that part of the discussion there, as interesting it is. Mark's going to be leaving the show for a short while, but we'll continue our discussion with Shahan, moving on now, where we're taking a look at a growing concern for businesses as uncertainty increases in the economy. Companies need access to finance to help them grow, be that through bank loans, private equity, investment or crowdfunding. However, the storm clouds over the economy from the Brexit negotiations may mean some lenders decide to hold on to their cash until they feel more confident the environment will be right for them to get a return on their investment. Keel and Webster found out how the fundraising experience has been working for some small firms.
Mum's Baked Cakes is a business that allows bakers from across the country to sell their cakes online. But whilst the delicacies are appetising, they found failure to get crowdfunding more difficult to swallow.
Back in, I think it was June, July time, we put ourselves onto Cedars, which is a crowdfunding platform. And we had set a target to raise £150,000. And it was, I think you have 90 days to raise the funds. Unfortunately, we weren't successful at raising the funds, but we learned an awful lot about it.
The Brexit vote has caused a degree of uncertainty surrounding the economy, which could make it harder for businesses to get funding. Having said that, the economy did increase by 0.6% in the aftermath of the vote, a far greater growth than many anticipated. And it's set to grow once more this year, although the forecasted increase has been altered since the vote to leave the European Union.
With Brexit, possibly the investors may be slightly more nervous. I'm hoping that they can get through that and look at British companies, look at investing in businesses that want to help local economies. As ours is a business that supports local businesses, we have hundreds of local bakers all hand delivering in their local area, and I'm hoping investors will look at somebody like us that's going to continue to recruit locally and support the local economy.
So, Shahan, what do you think the environment is like at the moment for businesses trying to get access to finance?
Very, very tough, Chris, very tough. The recession made lots of people very nervous. Funding tends to come in two different packages, bank funding and private equity. Both of those are essential really for a growing business to be able to move themselves forward. Ultimately, only so much can come from the business itself to create the growth model. Bank funding from the traditional banks is very, very difficult to get a hold of. They're very nervous about where things go with new businesses, but also if you put on Brexit, potential interest rate rises, these uncertainties make them very nervous on their models. Private equity is a bit more bullish, looking to lend, but it's about finding the right products to be able to produce for that private equity position. So as a whole, it's a very tough market for new businesses and evolving businesses to get the funding.
The government is clearly trying to do a bit more. I mean, we saw last week Kent County Council has relaunched its Kent and Medway Business Fund, which is interest-free loans to growing businesses used by money they've actually had paid back to them from interest-free loans they've given out before. Do you think that the government is doing enough to try and make the environment for small businesses getting hold of money, sort of viable and fluid?
I think they're trying. But all these initiatives, they take time and it takes resource to be able to push those through. You need funding in itself to be able to do that. And it's not coming through fast enough. Everyone off the back of the recession wanted to move. There was a long delay. It was a deep and dark one. And now what people are trying to do is move quickly. But it is hard to get through those processes. There's lots of things that government could be doing to incentivise the growth of companies, entrepreneurial companies that want to be pushing forward. In terms of property, there's lots of things to do with the planning side and finance that can be done as well to support the growth of this type of entity. But ultimately, there's not enough there. There's not enough incentivisation to do it. And until the bigger banks as well start to look at moving forward with funding, perhaps with some support from the local authority side of things, you're still going to be in a stagnant position.
Do you think that, what do you think of the bank's approach to lending, particularly since the financial crisis in 2008? I mean, are they being too cautious when it comes to lending to the small types of business, or is there anything maybe businesses could be doing to make bank lend to make it easier for banks to lend to them?
I think business-wise, businesses are doing everything they need to do. Where banks got nervous was off the lending to individuals who were pushing for, particularly with property purchases. Businesses themselves, though, have to be very robust in what they're selling as a product, and the due diligence that goes behind that I think is enough to be able to support for bank lending. But banks are still so nervous. What we are seeing, though, is the growth of the challenger banks. Challenger banks which have been born or pre-recession in a small entity that are growing to the sizes now where they're prepared to take more risk in their lending. Ultimately, this is about risk. But without a little bit of risk, without breaking some eggs, you're never going to be able to make that omelette, and you can't move forward. So the bigger guys, real struggle. The more challenger, smaller banks really come into the market, and they're the places to be looking if you're an SME.
How much do you think that businesses should be looking abroad for their money as well? Mark Quinn, our other guest today, he's managed to get investment from the Middle East for some PRS schemes, that he's putting forward. Do you think that businesses have an open enough mind when it comes to trying to get funding from, the non-traditional places?
I think some businesses have the difficulty of getting that access to those markets, and that's always going to be a complicated scenario. We're in talks with India at the second about putting funds down from there. But ultimately, it'd be nice to be able to pull the funds in from the UK. There is plenty of movement from the London market, particularly for the Kent. This is a Kent show, and essentially our biggest investor at the second is a London-based investor who don't want to invest into London anymore. They want to invest into the regions, Luton, but in particular Kent. And we're well placed to take that funding in to sort of deliver returns on it. But ultimately, the idea of getting access to private equity, there are lots of UK-based firms to be able to do that, but there are lots of appetite from the foreign markets too, because they themselves need to be diversifying their interests. Getting access to that funding is very hard for a new starting business, but as you evolve and your layers come into play, then you've got more credentials behind you to sort of source beyond the boundaries of the UK.
Brilliant. Shahan, thank you very much for your input there, much appreciated. That's it for the latest edition of Chris & Co, our show looking at the issues affecting business in Kent. You can keep up to date with all the county's latest business news at kentbusiness.co.uk, and you can follow us on Twitter at KentBusiness and join our pages on Facebook and LinkedIn. That's it for now though. Thanks for watching. Have a very good day. Bye bye.